Good morning, everyone. This is day 8 of just 20 minutes lecture series. We'll be doing assessment of charitable trust, assessment of business trust, and assessment of various entities, including assessments of AOP and BOI. We had completed assessments of partnership firm and company in the previous day. So let's look at charitable trust. This is a very important chapter. It comes for at least 4 marks in every attempt. If you have a look at the track record of the question papers, ICI question papers, then charitable trust is a very important topic. So it will be at least asked in the MCQ if it is not asked in the main problems. So how you can quickly grasp that with 2 marks, just 2, 4, 8, or 6 marks. Just pay attention for the next 10 minutes. For a charitable trust, the first thing is a charitable trust is defined. A charitable trust is a one who who carries on charitable activity. Charitable activity in the definition of charitable activity includes relief to the poor, education, medical relief, preservation of environment, preservation of monuments, yoga, which had been recently included, advancement of objects of general public utility. So if for example an assessee carries on these activities and they go through the process of registration, they will be allowed exemption under section 11 and 12. We'll be having a look at exemptions and what sort of exemptions are available to these trusts. But the main condition is first they have to satisfy this definition. So if an assessee is looking out for the poor, so is he allowed an exemption under section 11? Yes, because relief to a poor is a charitable activity. Now, along with providing relief to the poor, he does some business on the side that is ancillary to the business of providing relief to the poor. For example, he takes sponsorship from various other companies, big companies. A small organization is taking sponsorship to provide relief to the poor, and from sponsorship they earn some money. It may be called a business activity. For example, it is called. Then CBIT has clarified it will still constitute. So if a person is carrying on a relief to the poor and some business activity on the side, it will still constitute charitable purpose even if it incidentally involves the carrying on of commercial activities. However, separate books of accounts are to be maintained. So this is the basic condition. If separate books of accounts are maintained in exam, we have to write an assumption. If business income is mentioned along with these 6 activities, then we'll write it is assumed that the assessee has maintained separate books of accounts. Now to claim an exemption, the trust needs to register with CIT. So it will apply under section 12A to CIT. CIT may call for information, and after calling for information, he may order to either register the trust or to refuse the registration of trust. If the order of refusal comes, then it's not CIT is not the highest authority. Now, against the order of CIT, the assessee can go for appeal to ITAT, not to CIT appeals, but to ITAT, because CIT and CIT appeals are at the same level. For against CIT's order will not go to CIT appeals but to ITAT. Okay. Now, if registration has been claimed and later on the CIT comes to know that, for example, that activities are not genuine, it is only on the paper and for the purpose of registration and claiming exemption that the assessee had mentioned certain objects, but that are not real, then the CIT will cancel the registration. Okay. So similar conditions like this, CIT will cancel the registration. After this, this is charitable trust, meaning relief to the poor, education, medical relief, preservation of environment, monuments, and yoga. Now there's a residual clause known as advancement of objects of general public utility. It does not specify the activity, but it provides object of general public utility will not it so there's an exception to this clause that if a person is carrying out activity of general public utility, it will be considered as charitable activity. But if the assessee earns income in the nature of trade, commerce, or business, or other consideration, and it exceeds 20% of total consideration, total income, then it will not be considered as charitable activity. So for other, there is no limit. For six, these six, there are no limit. For this one, there is a limit of 20%. Only 20% can be a business sort of activities. Okay, so if income does not exceed 20% of total income, regardless of application of income, it will not be advancement of object of general public utility. Okay, now we go on to the computation. This is a very important part. There is a whole list of examples that ICI covers in their module. In my main book, main book, I have made a format, and it is a wholesale format. It is this this size, and it has details on the right hand side of the page as well, and it has all examples that you can have during exams. So please have a look at that book and the chapter of charitable trust in that book. It is, yes, available for download. I'll also share a link in the comment section. Income of property held under trust. So, for example, a trust carries on charitable activity. After carrying on charitable activity, the trust earns certain amount. For example, donations are received 110. For earning such donations, for example, the trustee of the trust went to collect those donations. For those collection, any expenses incurred, say expenses incurred for earning income, that will be added, or that will be, sorry, that will be deducted, because those are expenses. These are not expenses actually incurred for the activity, for the charitable activity, not for the charitable activity. These expenses are incurred for earning income. Expenses which are incurred for charitable activity will come down later, will add incidental income, and then we'll arrive at 100. So for incidental income, we have to write an assumption that separate books of accounts are maintained. Okay, and now, for example, 100 rupees is arrived. Now 15 rupees will be deducted as a statutory deduction. Okay, now listen to me. First of all, standard deduction of 15% is available. If I receive a donation known as corpus donation, the donate the person who has donated me that amount has specifically mentioned that this amount should go to, for example, laying a temple, for example, anything that is a corpus donation. It is earmarked for application. So the corpus donation is never treated as income in my hand, so it will not come under this. It Corpus donation will not be income at all, so it will not be coming under this. No 15% is required. Other donations will be coming here. Okay, now, for example, I have received some, I'm a trust, I'm receiving certain income. After receiving such income, I am not able to apply it during the year, so I may accumulate it for next 5 years. And after accumulation, if I am not able to apply in those 5 years, then I will have to tax that amount. Okay, so accumulation is allowed only for 5 years. Any other reason, accumulation is allowed. For example, income is not received at all, then the income tax act says, since it is not received, we'll consider that, and you'll not have to pay taxes in this current year, but in the future years, when you receive that amount, you apply in that year. If you don't, that will be taxable. Okay, so income tax act also provides a relief of one additional year. In case of non-receipt, it has to be applied in that year. Income tax act says apply in that year or the next. Other reasons accumulation, it says you have to apply within 5 years. If you don't apply within 5 years or the next, then it will be taxable. Okay. So income accumulated for non-receipt to be applied in the year of receipt or by next year. Any other reason? Maximum 5 years accumulation is allowed and may be deposited in specified securities as per section 11.5. Now this is one more important part. It's simply that since you have already received that amount and you don't have anything, you don't have any expense to incur. So income tax says might as well deposit in any other in a separate bank account and keep it there. So this is the specified, must be deposited in specified securities. Okay. Now this is the normal provisions. Now income to be applied as per time limit. For example, it had to be for a certain amount had to be applied within 5 years, and it was not. So it has to be taxed, right? For example, a certain amount of 20 rupees was to be applied during the preceding year. It was not applied during the preceding year and was not applied during the current year, so it will be taxable in the current year. For example, this is the amount. Okay. Now, less income applied for such purpose. For example, if the purpose is charitable activity, the charitable activity is relief to the poor. That will, if the amount applied for relief to the poor will be deducted here. Okay. Income of charitable trust 20. This is the final amount on which tax will be calculated. Normal. So basic exemption limit will it be available? Yes, it will be available. Normal income will be taxable at normal rates of tax. However, anonymous donations will be taxable at 30% flat. Anonymous donations are the donations which I am receiving, but I don't know the donor. I may be knowing the donor, but I have not recorded the name of the donor. Those are anonymous donations. So anonymous donations received by me will be taxable at flat 30%. Okay. Now, Income Tax Act provides certain relief for anonymous donations. Income Tax Act provides that 5% of total donation or up to highest of 1 lakh, you will be allowed anonymous donations to be taxed at normal rates. So if total donations is, for example, 100 lakhs, Income Tax Act says 5 lakh, 5% of 100 lakh or 1 lakh, whichever is higher can be considered as will be considered as your exemption. That is, if you have received anonymous donations of 25 lakhs, 5 lakhs will be considered as normal donation. It will be taxable at normal rates of taxes. Only the 20 lakh amounts will be taxable at 30%. Get it? Now this is it for charitable trust. Now we'll be coming to AOP and BOI. So AOP BOI, the simple logic is the assessee. Say for example, you people watching the video. For example, you have a look at the income tax provisions. In the income tax provisions, the first page it says for individual HUF and AOP BOI, slab rate benefit is available. So you go on to say your friends say if it says the AOP BOI. So you form a tax plan that we all will come together and we won't form partnership firm or a company. We'll form AOP because it has a normal rate of taxes. Basic exemption will be applicable to me as well as to AOP. We so logically you're not wrong, but income tax act says yes, it will be normal rates will apply to AOP if if the income of member, for example, you as a member of AOP have income less than 2.5 lakh and AOP has income of less than 2.5 lakh. For example, AOP has income of 5 lakh, you have income of 2.5 lakh. Income Tax Act says, sure, AOP will be taxable at normal rates, but your share in AOP will not be exempt. Okay, so here the Income Tax Act says the benefit that you are trying to claim will not be available. So, for example, if a member, none of the member has income exceeding basic exemption, none of the member is a foreign company. Normal rates will apply, slab rates will apply to the AOP. Okay, member share not exempt in the hands of member. In the current example, shareholders income was 2.5 lakh. The the share from 5 lakh will be taxable in the hands of in the hands of member. For example, share is 50%. 2.5 lakh will come here. It will also be taxable to AOP at normal rates, but it will come here to the shareholder. Now the shareholder will be taxable at 5 lakhs. There may arise a situation of double taxation. Okay, hence rebate is available under section 86. Okay, now the next point is um, more than one member income is more than basic exemption. For example, we four have formed a partnership or have formed a AOP. One person has income more than basic exemption limit, but none of the member is a foreign company. Now the Income Tax Act says don't no need to make don't need to make any complications. Directly tax the AOP at maximum marginal rate. No questions asked. Taxable directly at maximum marginal rate. Okay. Since AOP is already taxed at the highest rate, there is no sense in making the amount taxable to the member. Hence, it is exempt in the hands of member. Shares of members are unknown. For example, more than or equal to one members is a foreign company. Such members share, for example, foreign company is taxable at 40%. So if a foreign company comes into picture and says, I want to be taxed at MMR, I'll come under this category. Income Tax Act says no, you have a separate category for yourself. More than one member is a foreign company, you'll be taxed at MMR, but to your extent, to the extent of profits for foreign company, it will be taxable at such higher rate. That is 40% in case of foreign company. Such members share into such rate plus balance income at MMR. Okay, this is just an adjustment to this point. This is adjusted to suit this foreign company. Okay. Now, this is the category of where the shares of members are known. Since the shares are known, it can be bifurcated, right? If the shares are unknown, AOP is formed and AOP or BOI is formed, and the members do not know their shares, then these provisions, the next provisions will apply. None of the member is a foreign company, maximum marginal rate exempt in the hands of member. If one member is a foreign company, now you're seeing, now the SSC is saying, uh, I am a foreign company, I am a member in XYZ AOP. Income Tax Act says you don't know your share. I say I don't. Then the income tax says that entire income of AOP will be taxable at such higher rate. Simple. It is protection of revenue from income tax perspective. Okay, so if none of the members is having income more than basic exemption, it will be taxable at AOP, at normal rates to AOP will be exempt in the hands of the member. If one or more members is income is more than basic exemption limit, taxable at MMR to the AOP, but exempt in the hands of member. If one member is a foreign company, such share of foreign company will be taxable at higher rate, and balance will be taxable at MMR. If the the members say that they do not know their shares, MMR or such higher rate, entire income, because income cannot be bifurcated now. Simple. Now we are coming to business trust. In business trust, there's a simple concept of pass-through entities. What are pass-through entities? Pass-through entities are, say for example, this is an income. This is a business trust. Provisions of business trust provide that business trust in some cases will be a pass-through entity. Meaning, if an income comes, the business trust just pass through. The income will pass through and will reach the member or the unit holder. Okay, so income, what happens in business trust, the business trust invests in certain shares, securities, and very other infrastructural or income generating assets, and then it receives the amount which it distributes to the unit holder. Simple. Now for the purpose of taxation, the income which is coming to the business trust, the business trust can easily sway, as in the taxability will directly hit the shareholder. The business trust doesn't have to pay any tax, so business trust will be exempt. It will be taxable in the hands of the unit holder. Okay, this is a case of pass-through entity. In case where the business trust is not a pass-through entity, for example, an income comes and it hits the business trust. Now it is not a pass-through entity, it is taxable to the business trust. It will not be taxable to the unit holder. Okay, so there is no double taxation. There is only one level of taxation. In some income cases, business trust is a pass-through entity. In some cases, it is not. Let's see. Income from SPV. Interest from interest income is very unique because in case of SPV, both the business trusts, REIT and InvIT, are pass-through entities, meaning that the income will be taxable to the unit holder. It will not be taxable at all to the business trust. Likewise, for other interest other than SPV, it is taxable at MMR to business trusts, meaning that they are not pass-through entities, and it will be exempt in the hands of the unit holder. Is it clear? To identify whether an entity is a pass-through entity or not, there's a provision. What do you mean by SPV? It is given in detail in my main lectures, and also it is available on YouTube. There's a lecture on business trust. In my main book as well, the first page of this chapter, business trust, is dedicated to SPV and MAT adjustments related to business trust. You may have a look at that. We'll continue with the income and whether the business trust is a pass-through entity or not. The third point is rental income. Rental income from letting out of or renting or leasing directly any real estate asset. Is it a pass-through income? Yes, in case of REIT. Exempt in the hands of REIT, taxable in the hands of unit holder. No, in case of InvIT, taxable at MMR, exempt. So I have written down notice points, approach points that will help you during the exams. Like, you have to notice during the exam that the only difference in treatment between REIT and InvIT is in case of this rental income. In only this income, REIT is a pass-through entity, but InvIT is not. Okay. So rest of the income is similar to what we discussed. If it is a pass-through entity, for example, dividend from specified SPV, it is exempt in all the cases because dividend is an exempt income. Dividend from SPV is exempt up to 10 lakhs. It is 100% exempt. Long-term capital gains exempt. Other long-term capital gains, since taxable here, it will be exempt here, not a pass-through entity. Short-term capital gains, again taxable here, not taxable here, not a pass-through entity. Here other income, other none. So these are the income that we have already specified. Barring this income, if the business trust earns any other income, it will be taxable to business trust and be exempt in the hands of unit holder. Hence, unit holder business trust is not a pass-through entity in case of other income. So now I'll just brief you upon provisions of TDS and the how you can make your life easier in TDS provisions. So there are various things to mug up in TDS, like rates of taxes, the person covered, special points, the section numbers. So what I've done is I've made this chart, page number 18 of calendar book of the memory book. I have specified section numbers. I provided the nature of income. This is the percentage for this is the deductor, this is the deductee. Now special points. To explain you one section, for example 194I, it says it is taxable at 2% or TDS is deductible at 2% or 10% depending on the nature of rent. Whether it is for land or building, then it will be 10%. For furniture fixtures, it will be 2%. Who is the deductor? Deductor is income. IH means income or individual or HUF. Bracket means audit. Individual or HUF to whom audit is applicable. IH bracket A oblique others. Other assessees whether audit applicable or not. Okay. Then they are required to deduct TDS at 2% or 10%. Deductee should be a resident. Okay, wherever resident is given, resident. Eventually, this section 195 covers non-resident. So any deductions which are tax deductions which are not covered here because the receiver is a non-resident will come under 195. So for you, what every section you read, and after you read every section, you just write in short, because in exam you don't get a lot of time. In short, for example, for 194C, here you can write 1% for individual HUF. In your book, like those who have purchased the memory book, you can write individual or HUF. For 2% you can write others. Okay. Then here the deductor is IHA, meaning the deductor should be individual or HUF to whom audit is applicable or other assessees. Deductee should be resident. Now, for example, special point for 194C could be if the person is providing a bill of goods plus service, and if they are bifurcated, the value is bifurcated, then TDS is to be deducted only on the service component. Okay, like you may remember this point. If not, so this is a provision in 194C which provides that if an invoice comes to me, so I need to deduct TDS of that amount. At what amount should I deduct? If the invoice mentions the basic amount is bifurcated into two parts. The first is towards the material component, second is towards the labor component. At what amount should I deduct TDS? It is towards the labor component. If not separately given, if the total amount is given, I have to deduct on the total amount. So you can write it here in in one line, for example, service plus goods, separate, not separate, separate, service. You can write it, write service component, TDS has to be deducted, not separated, total amount. Okay, this is how you can make these notes for TDS. and you can make your life easy, because during exams, if you get time to read this simple chart in 10 minutes, it will make a lot of difference in MCQs or exam problems. It will make, trust me, it will make a lot of difference in your marks. That was it for today. We'll be discussing deductions and assessments tomorrow. Thank you.